How do you buy fractional shares on Robinhood? Portfolio theory has its roots in the management of investors' portfolios of stock exchange investments in fixed interest stocks. The following sections show how the attempt to identify an optimal portfolio for investors has led to a comprehensive but simple theory of how the capital market relates risk and return. This in turn will assist us in our attempt to adjust discount rates to allow for risk. The expected return of a portfolio is equal to the weighted average of the returns of the individual securities in the portfolio. So out of all the possible portfolios which an investor could make out of his chosen securities, which are mean variance efficient? Domination in investment dominates another if it provides a better return for the same risk or less risk for the same return. Inefficient investment is one which is not dominated by any other investment, whereas an inefficient investment is one which is dominated. Optimal portfolio: the efficient portfolio that is the highest utility for a given investor. This idea was discussed at the start of the chapter, and identifying this portfolio requires knowledge of the investors and difference curves. Some of these assumptions are obviously unrealistic, but they greatly simplify the model building process. Furthermore, even if the assumptions are relaxed, the theory will still hold approximately. A combination of RF and M produces portfolios which are better than any others in terms of the return which is offered for any given level of risk. Portfolios on the line RFM are achieved by mixing portfolio M with risk-free investments. Portfolios on the line MN are achieved by borrowing at the risk-free rate and investing our own funds plus borrowed funds in portfolio M. All rational risk-averse investors will hold the market portfolio according to the model we have just constructed. Note that it is not necessary for every investor to hold every share on the stock market. Replicas of portfolio M may be generated by holding as few as 15 shares. Investment in unit trusts will also achieve the same result. However, all investors do not have the same attitude to risk. By using the market portfolio and by either lending or borrowing suitably at the risk-free rate, the investor can choose any level of risk he likes and can predict the return which the market will give him. This return will be the best that he could possibly get for the risk taken. Rm and sigma M, the risk and return of the market portfolio. As the market portfolio should contain all risk investments, this can be estimated by using the risk and return on a stock market index such as the Financial Times All-Share Index. The capital market line tells us for a given level 0 risk the return an investor should expect on the stock exchange. It is often referred to as giving the market price of risk. That is, if we choose to take a given level of risk on the stock exchange, then we can expect a given level of return. If this is less than that offered by the project, it is tempting to say that the project should be accepted. However, there is a flaw in this logic.